Hello, welcome to Any Answers Answered for February 2018. Two questions, as ever, this month that Tim and I will have a look at. The first relates to property losses and has been asked by RG, who says a taxpayer has 12,000 of losses carried forwards from 1.5 properties. He moved back into his solely owned flat for an entire tax year while renovating his main residence, then let it again. He continued letting another property with his spouse, which made a small loss. Can all the losses be carried forwards against future profits? I guess the question he's really asking here, Tim, is it okay that he owns all of some of the properties and only part of some of the properties?
And the answer is yes, it is okay. And if you've got that scenario where a couple jointly own a property and it's not a partnership, that's the important proviso, then the half share that each of them has will be treated as part of that individual's property letting business. So the husband can own a property on his own and have a half interest in a property that he owns jointly with his wife, and that husband has a single property letting business comprising, if you like, 1.5 properties, and the losses and the profits will then be pooled and any excess losses carried forward against future property letting profits from that property letting business.
Okay.
So a relatively straightforward question, but I can understand why it arises. And the key thing here is to distinguish the treatment of property that is jointly owned without there being any question of a partnership, and property that is owned by a partnership. And it is occasionally the case that a married couple will form a proper partnership for their property letting business, but you do need to go through quite a lot of administrative procedures to establish that it's a partnership, not just the joint ownership of property. But let me just add one final point that wasn't raised in any of the answers to this particular question, but which will become more relevant as the months and years pass. The new or relatively new restriction on finance costs in property letting businesses where it's residential property allows a deduction against the total tax liability for the year of 20% basic rate on the so-called relievable amount. Now, the relievable amount, in essence, is the amount of the finance costs not allowed as an expense in the property letting business. And for the first year for which this applied, 2017-18, the current tax year, 3/4 of the interest or finance cost is allowed as an expense. The other quarter is disallowed, and that's the relievable amount. So ordinarily, we'd be deducting 20% of the relievable amount. However, the legislation actually allows a deduction of 20% of the lowest of 3 figures. The finance cost not allowed as an expense is one of them, but the net taxable property business profit, which will be after deducting any brought forward losses, is another. So the carry forward of the 12,000, I think it was in this example, losses, could reduce the amount of reduction against tax for the disallowed interest in the main computation. And although that sounds like bad news, actually it's not, because it's ensuring that we're not actually wasting any of that amount. We can carry the disallowed amount forward. So it's all getting more and more complicated.
I think this year, now we've got tax returns behind us, I think this year is going to be a very important year as we start to look at property income and how we deal with these finance costs, etc., etc. Just to clarify one point you made, in this example, it's a husband and wife, and that's obviously the most common reason for jointly held property. But the distinction between jointly held and partnership that you were drawing, the marriage is irrelevant in that
Correct.
sense.
So the only difference might be that whereas if they're not married or registered civil partners, the division of profit from the property letting business must follow the actual beneficial interest. So you could have tenants in common, brother and sister, say, owning a property 60-40, in which case it must be split 60-40. But if it was a married couple owning the property as tenants in common, still not a partnership, they could agree 60-40, but if they don't complete the Form 17, then the division of the rental income and losses and everything will be on a 50-50 basis.
Okay. Our second question this month is to do with marriage allowance. Now, marriage allowance is actually something that we covered on Tax TV this month as well. So there's, if you would like more information, do feel free to watch that interview. The question is from Jamie Thompson. It is a very specific question relating to farmers averaging. The question is an example situation. Farmer husband has nil income in 1 year, 30,000 in the second year. The wife earns £5,000 in each of those years. The question is, can marriage allowance work in both years? Of course, there's no benefit to it if we just left the figure at nil. We could get benefit at 30, but by changing that to averaging, having 15 and 15, can we use some of that unused personal allowance to wipe out the tax liability?
Well, the point of the question is that in the first of the 2 years, because the husband's farming income is zero, there wouldn't be any benefit in transferring the marriage allowance from the wife. But after averaging, he's then got 15,000 of taxable income in that year, and so yes, the benefit could then arise. And the very simple answer is yes, it is possible indeed to do that. And the advice there would be that when the averaging claim is made in the second year's return, there should be a claim made for the marriage allowance transfer in respect of the first year.
Because in that situation, if the wife has only used 5, she would have at least 5 left over, which would then wipe out any tax bill for the husband.
Don't forget, we're not allowed to transfer the unused amount of the personal allowance. The marriage allowance is given at a fixed percentage of the total personal allowance, and that fixed percentage is 10%. So for 15-16, when the personal allowance was £10,600, I think, the marriage allowance transfer will be 1,060 to be given at basic rate.
And of course that's my own fault there. So the answer would be that he would calculate his tax liability on whatever the 15 is over the 10.6, and from that you can deduct this 10% figure. It happens at the end of the calculation. Correct. As I was just saying before, we talk about this further on Tax TV, and also on Tax TV we talk about the fact that we're not really surprised that the revenues calculation software might not have come up with a figure that is as happy as we might have been. Hopefully useful. Do always post your questions on the Any Answers section of the website, and perhaps next month we'll be discussing your question. But for this month, bye-bye.